Americans are working the same hours and earning the same salaries as they did 3 years ago, but that income buys significantly less at the checkout counter. The math of the daily budget no longer balances. This erosion extends to savings. As the cost of essentials rises, the purchasing power held in traditional bank accounts is diminishing in real time. Economic data suggests 2026 is not a standard fluctuation in the business cycle. We are seeing a permanent restructuring of the American financial landscape. Those who rely on financial strategies from a decade ago are seeing their household wealth erode month over month. The old playbook cannot preserve capital in this new environment. Many households are currently in a holding pattern, waiting for consumer prices to drop back to 2019 levels. They are treating current costs as a temporary spike that will eventually revert to normal. This chart clarifies the mathematical reality. While inflation may slow, prices themselves have plateaued at a high peak. They are not moving backward. This plateau is the new baseline for everyday goods. Prices for housing, insurance, and services are locked into these elevated positions. Survival in 2026 requires accepting this baseline. Households must physically restructure their expectations and budgets to match the reality of these permanent costs. This permanent price floor has turned the middle-class reliance on debt into a primary financial threat. Under previous economic rules, credit cards and personal loans served as manageable bridges between paychecks. Low interest rates made it possible to carry a balance without immediate catastrophe. In a sustained high-rate environment, the cost of servicing debt explodes, even if the principal remains the same. This creates a mechanical squeeze. Rising living costs drain income from the top, while high interest rates consume capital from the bottom. Preserving wealth now requires the aggressive elimination of all high-interest liabilities. Debt is no longer a tool, it is a drain on survival capital. Beyond consumer debt, the American suburb is currently experiencing a fundamental shift in how wealth is built through real estate. The traditional path involved buying a starter home, building equity, and eventually selling that property to upgrade. It was a predictable ladder of wealth generation. That traditional ladder is currently frozen. Millions of homeowners are locked into historical mortgage rates far below current market levels. To move means sacrificing a 3% rate for one that is double or triple the cost. This golden handcuff effect has choked housing inventory. With few willing to sell, prices remain high, leaving first-time buyers with no entry point into the market. Real estate in 2026 is a locked asset. This illiquidity forces younger Americans to seek alternative investment vehicles to build the wealth their parents found in home equity. While physical assets are much harder to acquire, the most significant change is occurring in how we generate active income. The old rule favored specialization and tenure. You earned a specific degree, found a corporate home, and relied on seniority to guarantee your financial future. Automation and artificial intelligence are now reshaping white-collar industries. Tasks that once required an entire department are being optimized into background processes. The primary currency in this labor market is adaptability. Earning power is now tied to the continuous acquisition of new technological skills rather than years of service. Career complacency has become a direct risk to financial stability. In an AI-driven economy, an individual's income is dictated by their willingness to evolve. Navigating these threats requires a shift in how you personally respond to market volatility. Volatile markets trigger emotional responses. When investors react to chaotic news cycles or short-term price dips, they often make decisions based on panic rather than data. This visualization contrasts daily market noise with long-term risk management. By focusing on the wide trend corridor, an investor can ignore the jagged fluctuations of a single week or month. Successful navigation depends on understanding the fundamental value of the assets you own. You cannot predict erratic market movements, but you can control your exposure to them. Strategy provides the framework, but psychological discipline ensures the execution. Survival requires the ability to remain objective when the market is at its most irrational. This economic shift created significant friction, but it also marks a point of historic opportunity. Economic downturns facilitate the transfer of wealth. As asset values and market structures change, capital moves from those who are stagnant to those who are prepared for the new environment. Financial awareness is the dividing line in this decade. Understanding the mechanics of inflation, debt, and labor allows you to position yourself ahead of the transition. The requirement for this era is clear: stay informed, prioritize long-term stability, and build assets with calculated precision. The American economy has reset. By isolating the specific drivers of this shift, you have the information necessary to navigate and participate in the next phase of wealth generation.